Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined today by George Goncalves, MUFG's Head of U.S. Macro Strategy. It's Tuesday, July 25th, 2023. Welcome back to the podcast, George.
Great to be on, John.
Good to have you. So, George, treasuries have been largely in a holding pattern since the last time you were on the podcast. That being said, risk continues to trade well. Stocks trading, are trading two new year-to-date heights, and credit, I think, is year-to-date tights and perhaps longer than that. Why don't you give us a read on the latest price action?
Yeah, absolutely. So July kind of continued on how the first half ended, which is still with kind of upward momentum in risk assets. But even having said that, there is some hesitation to breaking really new higher levels on the S&P. This 4,600 levels really proving to be more difficult. But nonetheless, just a general more upbeat tone from market participants. Earnings have been coming in. As always, expectations for earnings are always managed down before earnings season, and so it's looking like some numbers are looking better than people were worse or were expecting to happen. It's not as bad as it could have been, but there is some sectors of the earnings spectrum that are showing still some concerns about the second half. But people are climbing the wall of worry, as they say, and credit really just continues to kind of be a world onto its own, where there's a lot of kind of credit money sloshing around that it's got to get put to work, and supply has been a little bit on the lighter side, and we're getting to that point in the summer where it's that midpoint into the that kind of August early kind of people going on vacation mode, so and just less issuance. So I think like the technicals look favorable. I'm not sure it's really a reflection of fundamentals per se, but there's still, again, all that liquidity and money and these specific mandates. And then rates, we're in an interesting spot. Having seen a pretty big bounce in early July to high rates after the ADP report, and then really the inability to maintain those high levels of rates, and really just stuck under a cap on rates, even though what's going to be the most televised hiking, or maybe the last hike, we'll see. But this televised hike of the Fed coming up is not really budged rates higher. So even though the Fed's going to hike, it's largely a token gesture when you go out beyond the T-bill market. So I think we're really, at the end of the day, really waiting for the Fed and a lot of the other central bank action that's still lies ahead for the week. And then I think August is going to be unclear if we get the typical seasonal pattern or if we get an anti-seasonals, and that really is going to come down to any of the event risks that we mentioned in the last podcast.
And that's a perfect segue to the next question. As a reminder for our listeners, we are recording this episode on Tuesday, July 25th, one day before the FOMC announces the decision from its July policy meeting. George, you just put out your FOMC preview. Why don't you tell our listeners what you're expecting from the Fed tomorrow?
So, we do think that just as the market's priced in, they're going to deliver on the 25 basis point hike. So I think that's a foregone conclusion. The real challenge is going to be for Chair Powell to not come across as dovish. I think that's really the aim for tomorrow. There's no forecast updates. That's on the quarterly meetings. So we're just going to get to hear Chair Powell after the press remarks and the opening remarks, and how he answers Q&A. I think it's going to really what sets the stage for the markets, at least for 12 to 24 hours into the next major events like the ECB and the BOJ. But I think Chair Powell can thread the more hawkish needle. If you recall that in Sintra, Portugal, he was sounding, as well as other recent events before the blackout, Chair Powell was sounding on the more hawkish side, suggesting more hikes or even back-to-back hikes. So I think he has the ability to still thread the hawkish needle and downplay the one weaker than expected inflation reading that we had from CPI, and that their job's not done. So if he kind of fights the grain on that, and the markets seem to be set up for kind of a dovish neutral outcome. If he can lean more on the hawkish side, I think it's going to matter. So it comes down to press conference more so than the statement and the actual hike itself.
Okay, so it sounds like a hike is a foregone conclusion statement, maybe, not likely to change too much. So it's all up to Powell to see how he plays the press conference. And yeah, and I believe you said you think the market's set up a little bit dovishly. So it sounds like there might be a chance that he could thread that proverbial hawkish needle. And man, you've got a tough job. Not only do you have to forecast what the Fed does, but you also have to forecast how the market would react, which is not, which as many of us know, it tends to be, can be counterintuitive. But why don't we try for benefit of our listeners? So the question is, what sort of reaction should we expect from the market given the scenario that you've laid out? And also, and you mentioned this a little bit in the previous answer, but what about that ECB meeting on Thursday and the Bank of Japan meeting on Friday? How could those events impact our markets?
Yeah, so I think just thinking about the setup, we do have, again, risk assets going in closer to their local highs, credit very tight. So everyone's on a hope for this is the end, and we don't think that Chair Powell will explicitly come out and say that they're done tightening, even though inflation has turned the corner. So I think him pushing back and trying to avoid sounding dovish and suggesting that there's more work to do and that they're going to stay higher for longer, and that remaining restrictive is what they're aiming for. Anything that he can throw at on the hawkish side to try to make sure that financial conditions don't ease, because that could either help reflare up inflation later on and just kind of keep things in check. I think mention of oil prices and that it's not clear that they're going to go back down. In fact, they've actually been rising, and that the path for inflation remains uncertain. If he can kind of lean that way, I think that it is generally bearish for overall assets. What's not clear though is the curve. We do have the bellies of the curves much more richer than the wings. So like the 5 to 10 year part of the curve have been trading significantly under Fed policy, whereas the 2 years closer, even that's a stretch. So I do think it'll be an overall bearish environment for rates, but for now we've been acting as if, in markets been trading, whenever the Fed hikes, it's more of a bear flattener. The risk is that we get this kind of anti-move that we're used to, which it becomes more of a bear steepener, and the realization that the Fed's on hold for longer and at much higher rates than what's priced in for the 3, 5, 7, 10-year part of the curve. And that does some heavy lifting tomorrow. I think that would be the pain trade, is a bear steepener, and that could kick off with Powell leaning on the hawkish side, and that's not assuming they don't say anything on the balance sheet, which always can come down the road. So I think they want to push up intermediate rates. I think that it's been one of the reasons why housing and other more interest rate sensitive sectors have done better, is because rates really haven't climbed higher. It's just the front end has followed the Fed, not the rest of the curve. So any sort of kind of way that he can kind of manage to get that outcome, I think it's really going to hurt that part of the curve, and could be dollar positive too along the way. And then that brings us up to the ECB and the BOJ, which if the ECB hints that they're going to go to a Fed type format, which is like hiking every other meeting, which again, that's not what the Fed has laid out, but if they start to get into that pattern, that's what markets would assume. So if the ECB were to kind of hint that September is not a done deal and that they might take a pause as well, I think that would always that would move the dollar as well, and also be bearish for the bellies of the curve. And then I think the big one is the Bank of Japan. At this point, I mean, most people have now kind of moved towards that there's not going to be a change, but with these sort of large shifts in policy, like removing YCC would be, you kind of have to have a surprise element. So if there was a surprise from the BOJ, that also would really hurt the belly and intermediate part of global rates and drag up U.S. rates with it. So that's the setup. I mean, I think that's the risk, is the bear steepener with like a 1, 2, 3 punch from the various central banks, and then we have a lot of supply to deal with also, and then we have the upcoming Treasury refunding announcement, which could also kind of add to that. So I'm thinking about the anti-seasonal August might be a title coming soon to one of our publications, but all joking aside, I mean, usually the markets have been doing the opposite of what we've been thinking. So might as well, think outside the box this time.
All right, so you heard it here. Stay tuned for the upcoming publication, the anti-seasonal August. But yeah, no, great stuff, George. So it sounds like there's a lot of reasons for the Fed to try and push back that this is the last hike and be hawkish. So be on the watch out. Be on the watch for a potential bear steepener pain trade in rates there. And as you mentioned, again, our official call is for that the BOJ does not change policy at this meeting, but certainly a very large risk that could be meaningful for our markets. So to our listeners, for more, definitely check out George's recently released July FOMC preview entitled One More and Done. And if you are not receiving his stuff, please get in contact with George directly. That was super helpful, George. Very comprehensive. Appreciate you coming on the podcast.
Thanks for having me, John.
And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales representative for any further information. Check back soon for more insights from the Global Markets Research Team.